Hello, everybody. My name is Mohit Kumar, and today I would like to talk about short term versus long term capital gains. First, let's understand what is capital gain is. Whenever you sell a capital asset for more than you paid for it, the result is a capital gain. For example, you purchase something for $1,000, let's say Apple company stock, and you purchase it on January 1st, 2020. Then you hold that stocks for about, let's say, about 11 months, and then you sell it on, let's say, on November 1st, 2020 for $2,000. So in this case, you have a $1,000 short term capital gain. Now, short term capital gain in general is whenever you sell something within 365 days. Then let's talk about long term capital gain. Now, in same example as before, you purchase stock for $1,000, but in this case you sell it on January 5th of 2021, and you sell for $2,000. In this case you have a $1,000 capital gain, but this time it's long term capital gain because you hold the stock for more than 365 days. Now there are some key difference for holding the stocks for more than 365 days. Long term capital gains, the maximum tax rate you pay is 20% based on 2019 2020 tax rates. So if somebody, of course, if you are single, and your income is over, sorry, bad handwriting, but let's try to fix it. Income is more than 434,550 approximately, you will pay about 20% tax on federal side. And just remember one thing, whenever we say 20% federal tax, right, it's just a 20% income tax rate. On top of it, you pay also something called net investment tax. And that again might vary depending on your overall income. And then if you live if you live in a state or city where you have to pay tax, let's say New York State and New York City, you will pay tax based on your ordinary income tax. Now let's talk about short-term capital gain tax rates. Short-term capital gain gets taxed at your ordinary income tax rates. For example, if you are in 35% tax bracket overall, your short-term gains taxed at 35%. So as you can see in this example, that you are paying much higher taxes if you are making much at the high tax effective tax rates. You will be paying more tax on the short term capital gains versus long term capital gains. On the state and city, it doesn't matter if it's a short term or long term. State and city, you still pay based on your ordinary income tax rates. So, of course, I mean, if you're planning to sell your stocks and you're doing some kind of tax planning, and if you think you can hold the stocks for more than more than a year and still make same type of profit, I would recommend holding the stock for more than a year and then pay less taxes. I hope this kind of helps understand something about short-term capital gains and long-term capital gains. I would I would try to put more videos on my channel, and if you would like to see and want me to cover some specific topic, please feel free to comment, and please do share this video, and if I can, and please feel free to give your feedbacks. Thank you very much, and I will see you